Good afternoon. In this exercise, we're going to be looking at the MACRS method of depreciation. MACRS is the acronym for Modified Accelerated Cost Recovery System. This is an IRS prescribed method, and we'll see how to work with it using this exercise. Francis Corporation purchased an asset at a cost of $50,000 on March 1st, 2017. The asset has a useful life of 8 years and salvage value of $4,000. For tax purposes, the MACRS class life is 5 years. We've been asked to compute the depreciation for each year from 2017 through 2022. So a couple things for the MACRS method. This is prescribed by the IRS, which is the Internal Revenue Services. The information presented here in red needs to be ignored as far as the problem is concerned. The useful life is 8 years, but what matters is the classification of the 5 years. The salvage value of $4,000 is irrelevant for the depreciation expense calculation. Hopefully at the end of the life, we do get some $4,000 when we sell it, but for the purposes of the depreciation expense calculation, we ignore this entire information that's marked in red. So let's scroll down over here and look at the MACRS method. Depending on the class, the life of the asset, 3-year class, 5-year, 7-year, and 10-year, you're using the 200% double declining balance. That's a double declining balance method. For the 15-year, it's 150%, and for 20-year, it's 150%. We don't need to calculate the depreciation rate because it is given to us. Now, for the 5-year life, the recovery period is 6 years. Which is why in our exercise, they've asked us to calculate the depreciation expense for 2017 through 22. As with any of these exercises, let's pull out the relevant information. The relevant information we start with is the date of acquisition. In this case, we acquired the asset on March 1st, 2017. The next is the cost of the asset. The cost of the asset is $50,000. This information of salvage value, I'm writing it here, but putting a line through it, striking it out, telling you that I do not need it for the purposes of this calculation. The depreciation base is going to be $50,000, which means this is the amount that needs to be depreciated. The useful life, again, I've written it, but I've put a line through it indicating that I have read the information, but I do not need it for this exercise. What I do need for the exercise is the MACRS life, that is the asset life as far as tax purposes are concerned, and it's 5 years. The cost recovery period is 6 years. So I set up a table, and in this table, the first row, I'm going to tell you what are the column headings are going to be. The first is for year 2017 through 22, and this is a 6-year period over which I'm going to recover the cost of the asset. It's a 5-year life, but if you look over here, we have 6 years in total to recover the cost of the asset. The depreciation base is $50,000. It stays the same number all the way through. The rate at which I'm going to depreciate it, I already have the rate given to me over here. You will always be given this information. The only thing you need to do is look at this table and pull out the relevant information, that is the rates over here. At this point, the last step is extremely easy, calculating depreciation expense. Depreciation expense is calculated as the depreciation base, in this case it's $50,000, multiplied by the rate of depreciation for each of the years, respectively. That'll give me my depreciation expense. So $50,000 times 20% will give me $10,000. $50,000 times 32% will give me $16,000. I do the same for the remaining 4 years. In this case, I'm going to copy and paste my formula, and I have my depreciation expense for each of the 6 years calculated. Add up these numbers just to make sure that we have depreciated the asset fully. The entire $50,000, that's the depreciation base, has been depreciated. The journal entries are fairly straightforward over here. Our journal entries I've given you for the first 2 years on December 31st, 2017 and December 31st, 2018 It's depreciation expense debit, accumulated depreciation credit. And also what you would note over here, unlike other methods, the date of acquisition does not affect the depreciation expense for the first year. Whether I bought it on the January 1st or March 1st, as in this case, or any time during the year, I will depreciate it 20% in year one. That's a formula prescribed by the IRS. So depreciation expense debit, accumulated depreciation credit, and I pull the numbers from the slash column. And that pretty much is all there is to this particular exercise. So once again, to recap, we are going to depreciate the original cost of the asset, the entire amount. We ignore salvage value. We ignore the estimated useful life of the asset. What we're concerned with is the maker's life of the asset. That's what we're concerned with. So there are only two pieces of information I need from the problem: the original cost and the maker's life. Once I know the maker's life, look to the table, look for the relevant column, and pick the percentages that you would need. So a fairly straightforward calculation of depreciation expense in this particular method.